Hi everyone, welcome to this video where I will be sharing more on what you need to know about investing in unit trusts. Unit trusts, sometimes also known as mutual funds, are collective investment vehicles that collect and pool money from many investors. This sum of money will then be invested in various asset classes, typically equities, bonds, government securities, and money market instruments, but can also include alternative assets like commodities and derivatives as well. The overarching strategy of a unit trust, which affects what underlying assets you can invest in, is often clearly defined. Together with a team of analysts, the fund manager will then be responsible for implementing the fund's investment strategy and managing its trading activities. The fund manager will also be responsible for monitoring and rebalancing the fund, which refers to buying or selling investments to bring the fund's asset allocation back in line with the overarching strategy. The fund manager and the team will also prepare a monthly fact sheet that provides an overview of the fund. It is meant to be an easy report to read, which also serves as a great starting point when you are evaluating an investment. Key information you can find in this document include the fund's aforementioned overarching strategy, fee structure, top holdings, and historical returns. Here are some other key characteristics of unit trusts that you should take note of. Unlike exchange-traded products like stocks and ETFs, the net asset value of a fund, hereby referred to as NAV, is typically calculated at the end of the market day. This means that there will only be one traded price per day. If you purchase Fund A today, do note that the actual price that you transact in will only be available 2 days later. Typically, a fund consists of hundreds of individual securities and assets, and calculating the value of each of these small moving parts is no mean feat. Also, these assets are often listed globally across a variety of exchanges and countries, and these markets open and close at different times. Due to this complexity, NAV calculations take time and hence are typically only available after 2 days. Finally, when it comes down to unit trusts, investors should know that the majority of them are actively managed, with the fund manager being responsible for implementing the fund's investment strategy by choosing which securities to invest in. Typically, the goal of active management is to outperform passive strategies. When making this decision, there are many factors that a fund manager has to consider. Firstly, unit trust managers often face limitations in what they can invest in. For example, fixed income funds are restricted from investing in equities, or an Asian-focused fund may not be able to invest in the US. Another common constraint includes ESG-related exclusionary screening, which could limit the fund manager from investing in certain sectors due to ethical reasons. Secondly, fund managers also often consider macroeconomic factors. Often referred to as top-down screening, the fund manager will take into account broad market drivers such as changes in economic conditions like the interest rate environment, or demographics like an aging population. From there, the fund manager will then narrow down to countries, sectors, or themes that might benefit from the economic environment before deciding on the specific underlying security or securities. Another common factor to consider are company-specific factors, often referred to as bottom-up. The fund manager will take into account fundamental company-specific factors. By researching companies, the fund manager then aims to identify those that stand out amongst their peers and are likely to outperform. This is unlike passively managed funds, where the holdings of the funds will move in tandem with the changes made to the underlying benchmark index. Unit trusts are a good way to gain exposure to certain markets or sectors. With a wide variety of strategies available, investors can choose a product that fits their investment view and risk profiles best. Even within the asset classes of equity and fixed income, the strategies and therefore the corresponding risk and expected returns can vary greatly. Investors hence have many ways to express their investment views across asset classes, sectors, countries, and even themes. Balanced funds is a unique category for unit trusts where they usually have a benchmark asset allocation of 60% equity and 40% fixed income. For investors with a long investment horizon, having a mixed allocation to equity and fixed income could allow them to gain access to both growth and income opportunities. Balanced funds can also be viewed as a one-size-fits-all product that aims to provide a diversified asset allocation. There are more niche strategies in the unit trust space that we typically classify under alternative investments. One example is the JPM Global Macro Opportunities Fund, which invests in equity, fixed income, gold, currencies, as well as derivatives. The fund has a broader investment mandate compared to many of its peers, giving the manager more flexibility regarding asset allocation. In exchange, investors undertake significant manager risk, or the risk of underperformance due to poor management, such as making a bad investment call. One relatively more common alternative investment strategy offers investors exposure to commodities. One example is the Threadneedle Enhanced Commodities Fund, which gives investors exposure to various natural resources, such as crude oil, copper, and soybean, through derivatives. Unit trusts categorized under alternative investments typically have different risk drivers compared to regular equity, fixed income, and balanced unit trusts, and are typically not recommended for new investors. Investing in unit trusts also comes with several key benefits. One of the main benefits of investing in unit trusts will be to help provide some diversification to investor portfolios, especially those with limited investment capital. Investors in unit trusts are buying a basket of different products, reducing the risk of company-specific events that could have an outsized impact on a portfolio. Beyond diversification, unit trusts also offer access to various markets and asset classes that may not be easily available to retail investors. For example, certain emerging markets are hard to access due to a variety of reasons, including high upfront fees, high currency exchange fees, large trade sizes, as well as limited brokerage access. However, unit trusts can lower the aforementioned investment barriers and allow greater reach to these products. By utilizing an active approach, investors are also able to capitalize on inefficiencies in certain markets. One such example is in the small cap market, which is typically considered inefficient by nature. Given a wider dispersion of expectations and a lack of information available due to a lack of coverage by research firms, fund managers that utilize a bottom-up approach, supplemented by on-the-ground knowledge and interactions with company management, may be able to spot such inefficiencies and generate value for investors. With a better understanding of unit trusts, the next step is knowing how to choose the right ones. This is why we have formulated our very own recommended funds list that is based on our in-house selection methodology, with the goal of providing a good starting point for investors to start building their own unit trust portfolio. The unit trusts on our recommended funds list are selected based on a set of quantitative and qualitative criteria. The quantitative factors include track record, expense ratio, and several risk metrics of the fund. In addition, we also consider some qualitative factors, including the investment mandate as well as the fund's top holdings. Track record is one of the most important metrics to pay attention to, as one of active management's key goals is to outperform the benchmark. While past performance does not guarantee future performance, we believe that the manager's track record is a key factor in evaluating a manager's skill. In addition, we also include qualitative considerations in analysing a fund's track record to attempt to discover if any outperformance or underperformance is due to luck or skill. This should help to determine if this outperformance or underperformance is replicable in the future. The expense ratio includes the various expenses in running a fund, which includes transaction costs and administration costs. Expense ratios directly affect the fund performance as it is deducted from the value of the unit trust, meaning that a lower expense ratio should translate to a higher net return. However, past performance figures typically have already factored in the expense ratio into their calculations. Finally, we also look at a handful of risk metrics to better analyze each fund. For example, one metric that is taken into consideration is the fund's downside deviation. This measure focuses only on the bad volatility, which in our case refers to the standard deviation of negative returns. Another metric that we look at is the maximum drawdown of a fund, which refers to the peak to trough decline of a portfolio. This metric is usually taken into consideration to better evaluate a fund's risk appetite and risk management strategy. In addition, there are also some qualitative factors to consider. Similar to ETFs, we will examine the top holdings of the fund to assess the concentration risk of the fund and also to understand if the fund has a certain style tilt, such as value or growth. Investment mandates, which is a set of rules and objectives, are also something that we pay close attention to. Not only do they ensure that fund managers and shareholders are on the same page, but they also ensure that the fund is governed properly, which is important for long-term performance. Given the plethora of funds available, investors can refer to our recommended funds list, which we hope can help to cut through some of the indecision. Whether you are a new investor starting your investment journey, or an experienced investor looking to act on new investment ideas, this list should serve as a good starting point. Our recommended funds span across equity and fixed income asset classes, covering global, regional, single country, and sector-focused strategies. We are on a constant lookout for new categories to include in our recommended funds list that we believe may be interesting to investors. And this list will also be updated on an annual basis. And with that, that's all I have for today's video. Thank you for watching, and we'll catch you on the next one.